Hello class, welcome to this chapter 7 lecture video. All I can say is congratulations. I know in the summer class, things are flying by. You just completed your second out of your four tests. Okay, only 2 more to go. You are halfway through the class. Keep up the good work. Been monitoring the progress and I'm very pleased with how everyone is doing. Okay. Don't let it fall out on the last 2 units we have here. So we're getting ready to go through chapter 7, which is going to be talking about operating or long-term assets. And then we'll talk about chapter 8, which is current and contingent liabilities. And then that'll be the end of unit 3. You're only going to have 3 days for this chapter 7 and 2 days for chapter 8 because it's a little bit shorter of a chapter. So you're looking at your 3rd test again at the end of this week. And then we'll finish up with unit 4 is just chapters 9 and 10, long-term liabilities and stockholders equity. Again, we'll have to do that in about a week, getting through those 2 chapters, and then you'll have your final exam. All right, and I'll be putting more details out as we go along there. So let me get my screen shared here. Let's hop straight into chapter 7. You're going to need your chapter 7 outline for this. It's kind of what I'm going to go through with the slide presentation here. Make this slideshow. Maybe. And then we'll swap it here. All right. Chapter 7, we're going to talk about operating assets. Okay, so in this chapter, you should know what an operating asset is. Okay, these are long-term assets, understand some depreciation, being able to calculate depreciation, revenue and capital and revenue expenditures. The accountants for revisions and depreciation I've cut out, so you don't have to worry about that. Disposal of fixed asset we're going to do. And then we're going to not evaluate the use of fixed assets. We're not going to do the financial statement evaluation. And yes, we'll talk about the reporting and the book value and stuff, but impairment is something else we're going to leave out. All right, operating assets. Operating assets is something the company is going to buy and they're going to use for over a period of time. It's not going to be used just to create one revenue. It's not like a piece of material and then where they create the product and then it is gone. Okay, an operating asset is going to be something that is going to be used over time to create lots of products. Okay. Whenever we purchase them, we do not create an expense at that point in time on our income statement for the purchase of these operating assets. Instead, they go through a process called capitalization. Capitalization is where you make an expenditure, an outflow of cash into an asset. Okay. And then as we use that asset over the period of time that we expect to use it, we'll slowly expense it away onto the income statement. That kind of keeps with that matching principle. So, okay, we're expensing the cost of this asset over its useful life, however long we expect to use it to generate revenues. Okay, there's 3 major types. There's property, plant, and equipment. And that's what we're going to spend the majority of this chapter on. Okay, they go through a process called depreciation, which we talked about back in chapter 3 with adjusting entries. And we're actually going to learn to calculate some depreciation in this chapter. There's intangible assets. Those are things we cannot touch, patents, copyrights of the sort. If they have some kind of lifespan to them, they go through a process called amortization. We'll touch on that a little bit. And then natural resources. So if we buy land to take oil out or we buy land for the timber, stuff like that. As we take those natural resources away from the land, the land goes through a process of depletion. All right, so property, plant, and equipment, they are the tangible operating assets of the company. Okay, this is usually going to be this is our warehouse. Okay, this is all of the trucks we have, all of our forklifts for a manufacturing company, all the machinery inside there that's producing product and stuff like that. Those are all property, plant, and equipment. As you see, it's broken down into 4 things: the land, that's the site, that's not actually the building on the land, that is just the land itself. Okay, then there's land improvements, which is kind of a separate type of property, plant and equipment. These have to be permanent, okay? Stuff that is either embedded in the ground or like driveways put right on top of it. Land improvements are always something that is permanently done to make the land better. And then we have our buildings, office, warehouse, factory, stuff like that, and then our equipment, machinery, furnitures, automobiles. Yeah, so if you're thinking of PP&E in this classroom, okay, the Zoom cart that I'm recording this on, that is definitely some equipment. Okay, we would even call all the desks in here. When they originally bought, they were probably listed on the school's balance sheet as equipment. And then expensed as they expect to use them. Okay, how many classes have they sat through? They might be fully expensed by now. But that's the kind of thing. So that way, when this is set up so when companies make large expenditures to expand their operations, they don't take a hit on their income statement. And it keeps in line with that matching principle, putting expenses and revenues together. Okay, the historical cost principle tells us that all assets must be recorded at their historical cost. So all property, plant, and equipment is going to be recorded at what it originally cost. But it is not just the purchase price of the certain PP&E. Okay, this is a great slide to get to know. So when you're calculating what you should record this piece of equipment at, or what we should record this building at, it is not just a purchase price. As you can see, land there. For recording land, we might have real estate commissions, closing costs, old property taxes. Okay, clearing and grading. So if there was an old building on that land when we bought it, then we had to take that building away and level out the ground before we made it useful to us. That is considered a land cost. Okay. Buildings, whichever purchase price, closing costs, maybe if you design the building from scratch, the architectural fees, the building permits, all this stuff. Okay, this goes into the cost of the building that we are going to record. So the point I want to emphasize here is it's not just the purchase price. As you see with equipment, you got insurance, sales tax, transportation costs, cost of trial runs, which is interesting because I was a manager of a Dairy Queen and we opened up a brand new store and we brought in all brand new equipment. And for 3 weeks, we cooked food in that equipment and we wasted so much food just in training and making sure that people knew what they were doing and getting stuff ready. Those were all considered costs of trial runs that got to be put onto the equipment instead of creating an expense. So it didn't, even though cash flow was going out, it didn't look like we were losing money because we weren't even open yet. So it's just the way. And then as we started making sales, then we could expense those off, all that training and stuff. So very important slide to know here. And you'll have questions where I'll ask you what the initial recording value should be, where you have to decipher what is included in the price of the asset and what is not. So here we go. Drew Company acquired a new milling machine. Drew paid $20,000 in cash, signed a 1-year 10% note for $80,000. We had freight charges to ship the machine, and we had to install it, prepare the journal entry to record the purchase of equipment. We'll record the equipment at $108,000 and $2,000. That is the $20,000 cash plus the $80,000 note payable. There's $100,000. That was the purchase price. Okay, so that's why we have a credit out to cash for $20,000 and a credit to notes payable for $80,000. The $2,900, I gotta remember what it was. $2,900 was to ship the machine and the $5,300 was for cash installation. Okay. So the shipping and the installation costs both become part of the initial cost of the equipment. So when you add them all together, that's how you get the $108,200. The $5,300 installation was paid in cash. So it was added to the cash credit entry because there was cash going out, even though it was going to 2 separate people. Still cash going out on the same day. And then accounts payable, because it says that the freight was on account. So we create, excuse me, excuse me. We create a liability that we have to pay later. So there's an example of your initial recording of the purchasing of a fixed asset. All right, so we purchased a new machine to be used in the factory, which will not be included in the purchase of a new machine. Sales tax, yes, that is included. Cost to install the new machine in the factory, yes, that is included in the cost of the new machine. Cost to remove the old machine from the factory. That will not be included. Okay, you might think that they need to do that to set up the new machine. But that relates to the old machine, not the new machine. That is not going to be in the cost. And after we install it, cost of testing the new machine's capability, that is test runs. So yes, that will be included in your answer here. I don't know why it said D. I should have highlighted C here because even the explanation, A, B, and D are all costs of acquiring the new machine. The cost to remove the old machine is not allowed as the total cost of the new machine. So it's asking which one will not be included in the total cost of purchasing. So C should really be highlighted here. It's an error in the slides, but even the explanation lets you know that the answer is C. All right, so once we have acquired this property, plant, or equipment, we put it on its books at its historical cost, plus those other factors that I told you to learn there. The sales tax, the getting the land ready, you know, architecture fees, all that stuff. Once we have all that recorded, okay, it is an asset on our balance sheet listed right underneath current assets. Then we have our operating assets starting off with PP&E. We will list it on there always at its historical costs. But then as we use this machine, we are going to take it away, expense it through a process called depreciation. Okay, it's a systematic, rational manner of taking that total cost of PP&E, except land. Okay, land cannot be depreciated because land appreciates, it goes up in value. Okay, so just think land never gets depreciated, remember that. So for the buildings, the equipments, we are going to expense the original cost over the asset's useful life. Notice that it just has a systematic and rational manner. Okay, we're going to find out here as we start doing this, that there's multiple ways in order to calculate depreciation. The journal entry is always going to be the same. It's always going to be a debit to depreciation expense with a credit to accumulated depreciation. And just like we talked about in chapter 3, this accumulated depreciation is a contra account. It's listed on the balance sheet right below the asset it's associated with. So if we have buildings at 400,000, right underneath it might be accumulated depreciation of 100,000, which creates a book value of 300,000 there. The historical cost minus accumulated depreciation gets us our book value. As I just mentioned, there are multiple depreciation methods. We are going to worry about 3 of them here. And if you're out in the real world and you're working for a company, just remember the definition of depreciation is a systematic and rational way to expense the cost of the asset over its useful life. So therefore, if you could find your own way of doing depreciation that is systematic and rational, there's nothing that is going to stop you from doing that and being okay with GAAP rules. Get my light back on here. Okay, but we're going to worry about the 3 most common kinds of depreciation methods. Okay, we have the straight line, the declining balance, and the units of production. Okay, the most important thing we need to remember here is knowing no matter what method we use, we can never make the accumulated depreciation higher than the original cost. Okay, once we have depreciated the whole cost, even if we're still using the asset, we just no longer have depreciation expense. I don't like it when that sound goes off because I don't know if it's the video or, but I still have my audio on. Okay. All right. So when we go to calculate information, no matter if we're doing the straight line, the double declining, or the units of production, we're going to need to have some information we're going to need to know that's going to be given to us in our problems. In real life, you're going to know this stuff. So 1, we need to know the cost. What was the original cost of this property, plant, and equipment? 2, what is the useful life? How long do we expect this equipment or this building to last? Okay, if it's a truck, do we expect it to last 10 years, 15 years? If it's a building, are we expecting to get 30 years of use out of it or 50 years of use? However long we expect to use it. And then the residual value. This is also known as salvage value sometimes. This is what the asset will be worth when we're done using it. So if we expect to use this truck, so say we bought a truck for $50,000. And there's our cost. We expect to use this truck for 10 years. It's our expected useful life. And then when those 10 years are over, we expect we can sell this truck for $2,500. Okay, that would be the truck's residual value, what we expect to get out of it when we're done using it. Okay, it says here the cost of the asset less its residual value equals the depreciable cost. That is true for a couple of our methods, but in one of our methods it's not, so you kind of ignore that statement for now. So straight line. Straight line does exactly what its name implies. Okay, we are going to take the original cost of this asset and we are going to depreciate it in a straight line method, meaning every month, every year, we are going to just take the same percent of the cost off. Okay, so we bought something for $100,000. We expect it to last for 5 years, and we're going to, so every year we would have to take $20,000 off in order to get that $100,000 in 5 years. On your PowerPoint here is your formula. To get straight line depreciation expense, you calculate it by the historical cost minus the residual value. That gets us our depreciation base. And then you take that base and divide it by the expected useful life. And that is your depreciation amount. Okay. And that is per year, per month, whatever you use for your useful life. So on January 1st, we acquired a machine for $50,000. They expect it to be worth $55,000 at the end of its 5-year useful life. Morgan uses the straight line method of depreciation. Okay, first compute the straight line rate of depreciation. Okay, so to calculate our straight line rate, it's always 1 divided by the useful life. Okay, so 20%. For 5 years, we're going to take 20% of the depreciable base every year. Okay, to find our expense, we have our cost was $50,000 is number 2, minus the $5,000 residual gets us a $45,000 depreciation base. Okay, so for the next 5 years, we need to expense that $45,000. So we divide it by 5 years to find out how much we need to do each year. So that's $9,000 per year. If we were doing our books monthly and we needed to find out how much it was per month, okay, we can just divide it by 12. If we do our books semi-annually, okay, and we needed to record a depreciation expense twice a year. So now we know it's $9,000 per year. We multiply it by a half. We find out it's $4,500 every 6 months, and so forth. It's important to know what you're looking for here. Are you looking for a yearly rate, a monthly rate? Okay. Here is kind of what this is kind of called an amortization table or depreciation table. We started with our book value of $5,000. Our depreciation expense was $9,000. Accumulated depreciation was $9,000. So our book value at the end of year 1 was $41,000. In year 2, we would do another $9,000 of depreciation expense. As you can see, the accumulated depreciation keeps totaling up, and now we have a book value of $32,000. Okay. We do that for 5 years. As you can see, our book value gets the $5,000. Which is what we expect our residual value to be. So we will never go below that. Okay. If it happens to run into year 6 and we use it, that is just a blessing, and we do not have to record any depreciation expense at all because we've depreciated it down as far as we think we're going to do it. Whoops. And then finally, your journal entry for number 4, depreciation expense and accumulated depreciation. Okay. So kind of I hope this one up here helps you see how depreciation expense, accumulated depreciation, and book value all work together. Because you're gonna have to calculate some book values. And I kind of want to drive that point home. But that is straight line depreciation. Remember your formula here, the cost minus residual divided by the expectable useful life, which is normally given in years, will get you your yearly depreciation amount. Okay, the declining balance method, I call it the double declining balance method, okay, because it is an accelerated way to depreciate your property, plant, and equipment. So in order to get this, first we need to determine our rate. So for the double declining rate, I call it double declining instead of just declining because it is double the straight line rate. Okay, so if you remember when we calculated the rate for straight line, we did it in 5 years. So 1 divided by 5 was 20%. We were depreciating at 20% per year. Well, if we were to do that exact same question, now we're going to depreciate at 40% per year. Okay. Because we would find our straight line rate. So the balance rate is 1 divided by the useful life times 2 is another way to get this declining balance rate for this formula right here. That is 1 divided by the useful life, which equals your straight line rate, multiplied by 2, get your double declining balance. And then to find our depreciation expense, we take this balance we just found and we multiply it by the asset's book value. Salvage value plays no part in calculating our depreciation expense under this method. So here's the exact same question. Acquired a machine for $50,000, $5,000 residual value, 5-year useful life. So we have the 3 bits of information we need to know. 1 divided by the useful life times 2 equals 1 divided by 5 times 2, or 2/5, or 40%. Or you can say 1 divided by 5 is 20% times 2 equals 40%. So for year 1, our book value is $50,000 minus accumulated depreciation. At the end of year 1, we do not have any yet. Okay. So we multiply our book value 50,000 times 40%. So we get our depreciation expense for year 1 to be 20,000. When we make the journal entry, that moves it into accumulated depreciation. So our new book value is 30,000. So in year 2, we take our book value of 30,000, multiply it by the 40% again, our rate. So we find depreciation is 12,000. Keeps going down, keeps going down. Okay. We're always taking our book value multiplied by that 40%. As you can see, it's accelerated. It puts more depreciation at the beginning, less at the end compared to the straight line method. And then when you get to the final year, you just have 1 entry that you have to make here, because again, you will never go below your salvage value. Okay, even though we did not take it out at the beginning. So when you get to the end of double declining, you got to make sure that last one does not drop your book value below the salvage value. And of course, the journal entry is exactly the same with a depreciation expense debit and accumulated depreciation credit. And this is the amount they calculated for year 1. This is the good slide to know here. Once you find that rate, that rate is constant and always multiplied by the book value. And the book value is always the cost minus the accumulated depreciation. Our final method here is the units of production method. And again, this is just what its name applies. The major difference here is when we're talking about useful life, we're not going to be talking about a time period. Rather, we are going to be talking about how many miles can a truck drive? How many hours can this tractor run? Something like that, okay? How much production are we going to get out of it as our useful life? Okay. So once we know that as a useful life, then we need to calculate what amount are we going to depreciate for each time a unit is used up. So if we expect it to use 5,000 miles, what is going to be our depreciation cost per mile? Okay. To get that, we take our cost minus the residual value, just like we did in the straight line. So we're back to getting this depreciation base and divide it by the expected usage. So the expected miles, the expected hours, whatever the unit may be. And then once we have that cost per unit, we multiply it by the actual usage to find our depreciation expense. So here's this exact same question with Morgan Incorporated again, okay? So at $50,000, worth $5,000 at its end of its 5-year useful life, and they expect it to run for 30,000 hours. Okay, so we're using the unit of production method here. That 5-year useful life is irrelevant to us. Okay, because the useful life we're looking for is how many units is it going to run for, and it's going to run for 30,000 hours. Okay, so we're going to do this. First thing we do, calculate the depreciable cost per machine hour. Okay, so our original cost was 50,000 minus the 5,000 residual. So that gets us 45,000 divided by the 30,000 machine hours. And we see that we want to expense this at $1.50 per machine hour. So then when you go to do each year's depreciation, you take the cost per machine hour of $1.50, that is your constant, and you multiply that by how many hours the machine was actually used. So in year one, when they only use 3,000 hours, it was $1.50 times 3,000, your depreciation expense is 4,500. See, in year two, they used it a lot more, so they depreciated it a lot more. The 9,000 hours they used it multiplied by the $1.50 per hour created that higher depreciation expense. And as you see, we kept our running book value over there, and we will never, ever again. It worked out right this time, but if they would have used their actual usage would have been 10,000 in year 5, they still would have stopped at that $5,000 salvage value. You never go below your salvage value. Book value will never go below salvage. All right, so this is just kind of a visual example to show you how it works. Straight line. It's going to be the same depreciation expense every year throughout the use of that asset, okay? It's predictable. It's good for your income statement because you know what's coming. The double declining balance up here on the right-hand side hurts your income statement those first couple of years because you have that real high expense right after you buy the equipment. But in the latter years of the equipment's life, you're having less depreciation expense, which makes your income look better, okay? The units of production, the more you produce, the higher your income is going to be, naturally higher revenues. So it kind of matches, it's the best of the matching principle of actually of any of those three things. Okay, but it might be a little bit harder to estimate how many miles or hours you're going to get out of something. All right. All right, our floral company delivers here. What depreciation method do we want to use for our floral company? Says here units of production method. Okay, and there really is no right or wrong answer on this. It's just what makes more sense for your business. But I can see the units of production method being a good one, because what if you have 4 vans and one of them is your primary one? All right, and it gets used all the time. And it's only when you get really, really busy do you start using those secondary ones. So maybe, yeah, you want to do it off miles driven, so that way the vans that are getting the most use, the values are depreciating faster in the real world terms of depreciating. So you can depreciate their book value just as well. Okay, after we have bought PP&E, sometimes you need to do work on it, okay? There's 2 types of costs that can be associated with PP&E that has already been bought that we're doing work to. Okay, it can be considered a revenue expenditure. Now, these are just your general repairs and maintenance. Okay, if something breaks and you got to fix it in order to keep up its current capacity so it continues to work, that is normal repair and maintenance. That's a revenue expenditure. However, sometimes when you do work to it, maybe you're extending the useful life, or you're making it faster so it can do more production. It becomes more useful. So if you're modifying the asset to make it more productive, increase efficiency, make it last longer, these are called capital expenditures. Revenue expenditures get expensed immediately on the income statement, whereas capital expenditures become part of that asset, and we have to calculate it into the depreciation cost. Okay, so kind of study this chart, get to know this. The accounting for it is not all that important for this class, but be able to determine if it is a revenue expenditure or a capital expenditure. And finally, the last thing we're going to go through here on the terms of PP&E are disposal of fixed assets. Okay, there's a voluntary disposal, involuntary disposal, kind of count for the same. Okay, when we go to record the disposal of fixed assets, the first thing we always need to do, always, is make a journal entry to update the depreciation to that point in time. Okay, we might only record depreciation expense once a year, but if we make a sell in August, okay, we haven't recorded the first, if we sell it August 1st, we haven't recorded January through July. We have not recorded 7 months of depreciation. So we need to make an entry to record that depreciation first. Okay, once we have done that, then we will make a journal entry that takes the asset off the books. So it's on there as a debit at its historical cost. So we will credit the asset at its historical cost. We will remove the accumulated depreciation, which is a normal credit balance. So we will make it a debit balance. Then we will record anything we received. Okay, maybe it just became junk and we just had to throw it away. We received nothing, so we record nothing. But maybe we sold it, got some kind of salvage value out of it, got cash. So we record anything we received, and then we'd have a fourth line most of the time, and that would be for a gain or a loss on disposal. Okay, gain would be a credit entry like revenues, gains are normal credits, and a loss would be a debit entry. If we had to make a debit entry to balance out our journal entry, and a loss is like in expenses, it makes our income go down. And those get reported on in that other section of the multi-step income statement, because it's not our normal operations to be selling equipment, but we do record gains and losses in our net income. So here's an example here. We sold a machine for $22,000. Okay, so we received $22,000 cash for selling this machine. Had original cost of $100,000, which it was listed on our balance sheet at. Accumulated depreciation was $80,000. And it tells us depreciation expense from January to July 1st was $5,000. So the first thing we need to do is update. We sold on July 1st. So from January 1st to July 1st, there was $5,000 in depreciation that is accumulated that we have not made the entry for. So we would do depreciation expense for $5,000. Accumulated depreciation for $5,000. Okay, so now our accumulated depreciation is now $85,000. Okay, so it was $80,000, now it's $85,000. Okay, next it says to count. Okay, to calculate the gain or loss on the sale. Okay. The proceeds from the sale are cash value of $22,000 less the book value, which was the cost, minus the accumulated depreciation is $15,000. That is how you calculate the gain or the loss. It's what we received minus the book value. So here we have a $7,000 gain. You will also see when we go to do a journal entry here, if you forget that formula, you can plug it into a journal entry. First, we received cash at $22,000. That was step one. Record what we received. Second, take off the property, plant, equipment at its book value. So the equipment here was $100,000, was a debit. We removed it because we no longer have it. Step three, remove the accumulated depreciation right above that. It had an $85,000 credit balance. So we make it a debit balance to make it go away. And then we have to balance our equation out. In order to make our journal entry balance, we need to do a $7,000 credit entry. And gains are credit entries. If we had to do a debit entry here in order to make it balance, it would have been a loss. Oh, destroyed by damage. I would say that is an involuntary disposal through an act of nature. Pretty self-evident question there. Okay, last couple things in this chapter, intangible operating assets. These are stuff we cannot touch, but they definitely provide an economic benefit. Patents, copyrights, trademarks, leaseholds, franchise fees. Okay, goodwill. Goodwill is a very unique accounting term, which we'll talk more about when you get into your intermediate classes. Okay. So most of the time, these give you legal rights and privileges, like patents. Nobody else can make the product for 20 years. Copyrights and trademarks. Nobody else can steal your logo, use your written works, your musical works, stuff like that. Okay. A lot of times there's great value in having this stuff. Okay. They're always recorded at the cost, just so we use the historical cost principle also like that. Okay. And if they are going to be expensed off, they are going to be done in a process called amortization. Okay, so like a patent has a legal life of 20 years. So we probably do a straight line amortization of 20 years. The copyrights, it's the legal life of the author plus 70 years. So until an author dies, it may be hard to kind of put a value or any kind of loss on the copyright value. And the trademark is 10 years, but it can be renewed indefinitely. So every 10 years. Well, so it is not amortized. Okay. If they can be taken off, they go through a process called amortization. Franchises and goodwill are not amortized. And that's, we're not going to do a lot of the accounting on that. I just want you to know that the process is called amortization. Whoops. And finally, natural resources. If we buy land, okay, land is never depreciated, but if we buy land to get natural resources out of it, okay, it will go through a process called depletion, which is exactly similar to the units of production depreciation method. So you're not going to have any questions asking you to do depletion, but I want you to know that natural resources do not get depreciated. Rather, they go through a process of depletion as they are removed from the land. And that is it for your chapter 7 lecture video. I only have one handout video for you on this one. Make sure you watch that. That'll be a great help to your homework. And as I said at the beginning, keep up the good work. I'm very happy with all of you, and I'll talk to you again soon.